Yeah, I'm losing my edge.
Finding value in all-time highs, Pete, is a tough thing to do. It's this classic conundrum that occurs quite often, honestly, where the equity market is at all-time highs and it's been there for the last several days. And so you don't want to necessarily go in there and sell it. And of course, no one feels good buying the highest price. It's kind of like the age-old joke of like everybody who's buying a house feels like they're buying the
top,
all-time
sure.
high in the house market. But
Right,
then
until it is, yeah.
Well, but if you bought a house last decade, it's worth more than it is. It's worth more today than it was last decade. So it's like it's this weird thing where it's like, if I sell stocks, I could have sold them the last several days, and now they're in my face. I don't want to buy it because it's the all-time high, but buying would have been the best thing to do. So how do we find value here at these all-time highs, Pete? And it's actually not only stocks. I want to
He's going back to the well. I like it.
I want to rope in interest rates here as well and look at these two markets that, I mean, you've got the 30-year yield there in white, which has almost doubled here in 2021 from 1.5% to where we sit right now, almost at 2.5%. You have the equity market here in small stock 75, Pete, that hadn't seen prices above $70 in that equity index. And now we're comfortably at 75, like it's nothing. And it's just like this idea of what do you do to find value with two markets at all-time highs? And I pose a very high school response to you. Value's relative, baby. It's all relative.
Was that the
like
big thing, baby? Was that what made you guys? Is that what differentiated the cool kids at St. Ignatius?
I always think,
hey, I'm studying Latin, baby.
It is cool in my mind, but I always think about Vince Vaughn in Swingers. He uses he uses the word baby all the time, and so I'm trying to channel my Vince Vaughn.
So weird. Which I think, the old movies you pick.
Is he from Chicago, Vince Vaughn?
I think so.
Okay. So it's all coming together here, but this is just like a classic thing in high school and college where it's like, oh, like how do you define worth or so? And like the easiest cop out if you didn't do your homework was like, oh, it's relative, and the professor has to be like, good response. But it is relative here. Look at the fact that you have these two markets that are screaming higher. You got a 30-year yield, like I said, that's up more than 50% in 2021. But when you pit yields against stocks, not as great performance. I'm looking at 1-to-1, and I'm interested to see what you think here, Pete, about trading this 1-to-1, because my thing is the 30-year yield is now above 2%.
Right.
It's a $25 product almost at the small exchange. That's $2,500 with the $100 multiplier there. The small stock 75, obviously larger. It's a $70 product, which makes it $7,000. But the implied volatility in yields is double that of the equity market. So I'm almost ready to trade this thing 1-to-1. What do you think here?
I think traditionally we do this 3-to-1, especially with the 10s. I think going out to the 30s, which traditionally is a higher beta, higher volatility piece as you move along that yield curve of durations. I think bringing it down to 1-to-1 gives you a natural bias, which is I'm adding two correlated pieces. I'm adding a little bit. And this is what we really want to do up here on this. I mean, today is another day. Great, Russell down 1.5%, NASDAQ up almost 1.5%. SM 75 and sticks that finally corrected off of 1,050 points. You had a nice corrective move here. I think finding opportunity within this market that even on the down days seemed to pretty much do nothing but go up. This is a really interesting trade. This is the way you shade your bias. In other words, I want to add a little bit of short deltas, but I'm putting something to get against it. So how do I do it? I can adjust the ratio a little bit. So I think you're spot on. I think we still have the same bias in rates, that rates, while not going straight to 4% in the 30-year, are less likely to trade under 2% than above 2.5%.
Well, and I'm glad that you brought up the equity markets there, Pete, because it's similar. When you look inside of an asset class like we're doing here now in rates, we did this all the last week, which was finding value in the technology sector that was underperforming the stock market at large. Right. And we saw that came back to today, a huge move in that spread as technology is outpacing energy and the rest of the sectors. So that was a great move within the same asset class here. And it's a matter of, when we're talking about finding value in all-time highs, it's a matter of finding something to buy, to, like you said, Pete, shade your bias a little bit. Because if you are a contrarian trader and you're selling this equity market or you're selling this 10-year yield market, it doesn't feel good when it's just higher, higher, higher. Yeah. I mean, SM75 until today, Pete, 5 days in a row higher. Right. You do yourself a great service to find something to buy against it, even if it is, in this example, the 30-year yield product, which is a third the price, right, a third the value notionally of the SM75. Buying one of those against my short SM75 creates an interesting pair, and it gives me something to buy in this in these risk-on assets that continue higher. Same with this inside the yield market. Looking at the 2s and 10s, it's one that we've talked about a few different times here. And those of you who are saying, the 10-year, man, it's on a hell of a run, quickly got to 1.6% now, whereas we couldn't get above 1% for the greater part of 2020. You got to find something to buy against it when it continues to grind higher, grind higher, grind higher. You have to find some kind of value here. And this here in the TUT spread, I know a lot of people already in this trade, us included, but I just wanted to bring it to your attention. 1.5% difference between the 2s and the 30s, Pete. Right. The greatest difference since 2015. Now that's more than 5 years ago. And at that time, the 2-year rate, or the 10-year rate, I knew I had one of these confused. It's actually that needs to be S10Y. I'll change that here in a second.
I wasn't going to correct you, but well done by you.
But what we have here is a wider gap than we've seen in the last 5 years. And when it was a great difference, Pete, 10-year rates and everything else were way higher than they are now. Right. So just for context, what does that mean? It just means that for this big of a gap here, we saw an interest rate environment in 2015 where 10 and 30-year rates were above 2 and 3%. Right. And now it's almost like we're getting this steep curve for the yield curve, not even being necessarily in a normal environment. So this is just another tidbit that makes me believe at some point something's got to give here. And at very least, you're finding something, like I said, to buy against a product that just is continued higher, as we see in the TUT spread.
Absolutely. And Frankie, this is what we are always looking for when we talk about pairs trades, and be mindful of, we want a diversified set of occurrences. We want some different trade strategies, even within the same asset class. But we also want to be mindful of not getting too many things the same way. In other words, too much of a dependency on one thing leading direction. So this is another way to take advantage of, and it's funny because the market's, I think NASDAQ's probably 4% higher than where I was like, time to pull out the static deltas and sell shorts. And you would think the question, and I got the question, why wouldn't you do that now? It's 4% higher. And it's just the way I trade. There's too much energy right now to say I would rather scale in with appropriate pieces. If we get back to those same levels, then there's some two-way action back in the marketplace. I'm not a guy who likes to pick highs. So if you look at these in terms of, S&P's at all-time highs, NASDAQ not quite there, but railing up, I would rather find pieces to trade against it until we get a little bit of two-way action here. Now, does this slow down the pace? Absolutely. But what I like is, whenever we do a pairs trade, Frankie, you can look at that and say, who wants to buy a 260 or a 160 10-year? We were just at 1%, and we spent a lot of time between 80 basis points and 1%. Why would I buy the 160s? Well, when you're looking at a pairs trade, it kind of frees us because we're not trapped in that thing of, I'm buying something at the highs. We're not momentum traders. We don't buy stuff at highs to go. But here we're looking at relative value. So I'm not looking at, I'm buying a high in S10Y. What I'm doing is pairing something on a relative basis that gives me a very interesting pairs trade. So it kind of frees us up a little bit from thinking like, well, I can't buy the S10s against it because they're at all-time highs, or they're at highs for the last year and a half.
No, that's a great piece that I want to finish on here, is the liberating feeling of, looking at things relatively. Because otherwise, you look at, if you're a trend follower, then you're buying all these markets every day. And if you're a contrarian, then you're just looking to sell everything every day. And when you do bring the relative perspective into it, Pete, it does free you up to be like, all right, I'm not just short everything. That thing is relatively cheaper than this other thing. So I'm going to look at buying some of that and selling some of that against it. And that's a unique trade. You've diversified your portfolio, and it gets you away from this vibe of just like stocks up again, I need to sell them again. And it makes you feel just better. You're getting a better value, even though you are in these scenarios. If I'm buying S30Y and selling SM75 1-to-1, yes, I am buying the highs in the 30-year yield with this S30Y, but I'm selling the highs in the SM75, and if these things continue higher, this yield has a lot of ground to catch up on this market, and the correlation at 0.95 is great. Similar with the yields themselves, when you're looking at buying that S2Y and selling the S10Y, yes, yields are higher, but that S2Y has so much ground to make up, or that 10-year has to come down to meet it at some point, because we are at a historical extreme. So
I'm so glad
all-time highs.
I'm so glad you
value in relative.
I'm so glad you pointed that out, Frankie, because you look at that 0.55 correlation, you think, well, why should these revert? The correlation is not as great as what we saw. Well, when you look at correlation divergence, something has to give. The greater something diverges, the more the correlation gives ground. Now, for you and I think if we looked at, historically, we would argue this is a very low correlation, aka why we see the wide divergence. But we don't trade normalization of convergence, but normalization of correlation. But I think this speaks to a little bit of, this is why I don't put as much context in that 50.5 correlation as being, well, it's not a tradable pair. It's not a truly correlated pair. I still think the extreme is really interesting here. So looking at the mix of these, and especially the S30Y, SM70Y, that is really, that kind of surprises me. I always go back, and when I see that plus 90, I think that's such an interesting piece in terms of looking at the extremes. So we're looking at two different trades here, both. And I like this, we finding an opportunity, finding a number of currencies at all-time highs, instead of just saying, and you and I have, every time we've slipped a little bit, done this, well, they're just too high. Just too high is not a good enough reason to put on a trade. And this really reinforces that. So great piece of context walking us through this, Frank. Thank you.